Hey guys, welcome back to the 365 Days of Forex series, and of course, I hope you're doing well and enjoying these awesome videos so far. If you are, then be sure to hit that like and subscribe button as it really helps the channel out a bunch. So with all that waffle out of the way, let's get down to business. In this video, I'll be covering the basic terminology that you will encounter when you're setting up your trading account, because after all, if you don't know your way around your trading account, how are you ever going to be able to make money trading? So without further ado guys, let's get into today's video. What is a lot? Although this question may sound a bit weird to some of the newer traders out there, a lot is actually the shorthand for lot size, which is basically a term that represents how much currency you're actually buying or selling at a given time. For example, when you trade Forex, one standard lot is represented by 1.0 on MT4. This equates to 100,000 units of the base currency. So say for example, if we're trading one lot size of GBP/USD on a buy trade, I'll be trading 100,000 Great British Pounds. It's important to note that the exact value of the lot size changes depending on what you're trading. In the above example, our 1.0 lot size translated to a position of 100,000 pounds. But if you want to trade one standard lot of USD JPY, this would now equal 100,000 units of the US dollar. Alternatively, if you want to trade one standard lot size of USD, then you'd be trading with 100,000 euros. Should be pretty clear, right? Now you actually don't have to trade standard lots, as that would require you to start with a pretty large amount of capital from the get-go. Instead, with most CFD accounts, you can use small lot sizes called mini and micro lots to reduce the size of your position or even fine-tune that risk management. Mini lots are in multiples of 0.1 and a micro lot are in multiples of 0.01. To put this into context, a mini lot on GBP/USD is the equivalent to £10,000, whilst a micro lot is the equivalent to £1,000. If you're trading different asset classes, you most definitely cannot use the standard rules that apply to Forex lots. For example, a standard lot on a gold position would be equivalent to trading with 100 ounces of gold. This is much larger than a one lot size in a Forex pair, which is why so many beginners regard trading gold to be a much higher pace than FX pairs. To establish how large a position size a 0.1 lot size gives you for any instrument, you should consult the contract size information located in MT4. What is a pip? Unlike the type that you might find in Apple, pips stand for percentage in point, not percentage in profit as some signal providers have heard to be called in the past. It's generally the smallest price change recorded for any given exchange rate. However, you can see some brokers quoting spread in pipettes, which are 10 times smaller than a pip, hence why sometimes your majors may have a 20 pip spread. For currencies, a pip is usually represented by the fourth decimal point, which is highlighted right here. This is true for every currency pair except those containing the Japanese yen, which we will get onto a little bit later as they're a bit strange. First, let's take a closer look at a pip on Euro USD. So if Euro USD's exchange rate on a Tuesday is 1.1025 and the following day it's 1.1030, then the price is moved by plus 5 pips. If the next day prices drop down to the 1.1015 mark, then it's moved by minus 15 pips. For the next example, I'm going to hand the reins over to you guys, so feel free to pause the video and work this out yourself. If GBP/USD started the day at 1.31460 and appreciated to a value of 1.32230, what is this move in pips? Well guys, if you paused the video, welcome back, and if you didn't, thanks for sticking around anyway. Let's work this out then. The first thing to do is see that we are trading GBP/USD and that's appreciated, as we know because the fourth decimal point has indicated to us how many pips the price has moved. Well, I can confirm that the correct answer is plus 77 pips, so check and see if that matches up with what you got. Now we know what a pip actually is, let's take a closer look at how we should actually measure our trading success. Most of us have probably seen a lot of social media adverts referring to pips and highly profitable weeks where traders have apparently made hundreds, if not thousands of pips. Whilst this is not technically incorrect from the perspective that a positive pip count should, not definitely, but should relate to a positive P&L, it's vital that you don't get sucked into this amateurish method of quantifying how profitable you are as a trader. There's a reason that when you go to the bank to invest in their stocks and shares ISA, that they don't tell you that it makes 1,000 pips a year. and that is because pips mean very little when actually compared to percentages. When trading, you should always know how many pips in profit your trade is running, or how many pips price has to move against you before you'll close your position in a loss. However, this should only be the first step of recording how profitable your trade was. You should always then look back at what the percentage gain or loss was on that specific position. For example, if you risked 1% and you intend on closing your trade if it goes 1000 pips against you, then you know if you lose this position, you've only lost 1% on that position. This means that if you close at 500 pips in profit, you've actually only made 0.5% on your account, which sounds a lot different to 500 pips. Now let's get into some of the little more advanced stuff, which is still very important. What affects your position size? When you're trading with a margin account, you're able to utilize leverage, which allows you to open larger positions than the equity within your trading account. Leverage works a bit like a loan from your broker and is always noted as a ratio such as 100 to 1. Imagine you have £1,000 in your trading account and your broker has provided you with 100 to 1 leverage on that account. This means that you can essentially open positions up to the value of 100 times £1,000, which is £100,000. As I mentioned before, you can only do this when you're trading with a margin account, and this is because margin is the money that you're borrowing from the broker. Margin and leverage go hand in hand. The leverage is the amount of money you can borrow, and the margin is the difference between the value of assets that you have open and the amount that you have in total. If your broker has a margin requirement of 60% and you want to open a position worth £10,000, then your margin requirement will be £6,000. This means that you can essentially borrow the other £4,000 from your broker. Now that we know that the broker will happily lend you money that you can trade with, but what do they do when they have to make that call that nobody wants to receive when trading? The dreaded margin call. This is when the value of your account falls below the margin requirement with your broker. In this case, your account, including running profits and losses, fell below £6,000. Now to combat this, the broker will ask you to do one of two things. They will either ask you to deposit more money in your account to cover your margin requirement, or they will automatically close your positions to prevent further losses. If you abide by risk management though, you are likely never ever going to receive a margin call. By looking at the margin level on your MetaTrader 4 app, you can quickly get a health check on your account's margin to make sure you aren't going to get an angry call from your broker in the near future. It's simply the ratio between the equity in your account and the used margin and is indicated as a percentage. Let's use an example of a trader who has £5,000 in his trading account and is using £1,000 in margin. You would simply use the calculation of 5,000 divided by 1,000, which is the amount of margin that the trader is using, then multiply the value by 100 to get it as a percentage. This gives us 500%, which is perfect. To make sure that your account is always healthy, follow the simple rule that your margin should always be above 100%. So, you don't want to get margin called, so what lot size is right for me? Sadly, there is no definitive answer to this question. It boils down to what you feel comfortable risking per trade, the asset class that you trade in, and how large your stop loss is. Your lot size should always be tailored to each position, and to do that, we recommend you use the app Stinu when calculating your lot size. This app allows you to input your balance, chosen risk percentage, stop loss size, and the asset that you trade in, and will provide you with a recommended lot size based on your parameters for that exact position. So guys, now you know the intricacies of your trading account. There is one more thing that we need to cover. Why are you not subscribed yet? Over 70% of you guys aren't even subscribed to the channel who watch these videos. Stop teasing us and hit that subscribe button and join the FXE family already. So as always guys, I hope you enjoyed this video and I hope you learned a lot from this video. And as always, I will see you in the next one.